Namaste to all. Welcome you all on this another knowledge dissemination by the Accounting Standard Board, another webinar, and on a very, very important subject, which is the contingencies and the prior period accounting in the financial statements, the various type of contingencies and prior period items. And for this, along with my Vice Chairman, C. Abhay Hajerji, we both welcome the two panelists and the moderator. The panelists today, C. A. Kaleshwar Prasad ji and C. A. Bhavesh and Gondia ji. Kaleshwar Prasad ji has been with us a few times on this webinar and also being a regular contributor to the Accounting Standard Board. He has got more than 18 years of experience in the financial reporting, audit and tax consultancy work. He is also a regular faculty in the post-qualification Ind AS course of the ICI and has been a few times here. So I welcome Kaleshwar Prasad ji. And thank you very much, Kaleshwar ji, because today what has happened is that our two panelists, both the panelists, they had certain emergencies. So we are really thankful to both the panelists. Kaleshwar Prasad ji, 2 days ago and today itself in the afternoon, one of the panelists, he had certain family emergency, so he could not come. And so nice of you, Kaleshwar Prasad ji, for agreeing, and also Bhavesh Gondia ji, because he agreed today itself, just a few hours ago. So Bhavesh ji, again, having more than 11 years of experience in the field of accountancy taxation, and he also has been a regular faculty in the Ind AS course. So I really thank you, both of you, for being the impact players and taking out your very precious time to share your views. And to moderate these two, we have got another stalwart, CA Jatinder Sharma, from I would say small town as compared to Delhi, Mumbai, Chennai or Bangalore. He is from Jalandhar. He has got more than 18 years of experience in the litigation and the accounting and taxation field. And he has been the co-opted members in a few committees of the ICI. To start the proceedings, I'll request my Vice Chair, C. Abhay Hajerji from Bhopal, to give his initial comments on the subjects.
Thank you very much, Chairman Pramod Jainji, and truly an honor and privilege to be part of this very important webinar, I must say. And I think what a wonderful word you have used today. I think the impact player for both of them, I think it's the apt word looking to the IPL season which is going on. So I think thank you so much, Kaleshwar Prasad ji and Bhavesh Gondia ji, for making yourself present today for an important discussion on the AS 4 and 5. Into 2 is Ind AS 8 and 10. So I think these are two important AS and Ind AS which you'll be covering today. And really I would say is interesting. Why? Because the prior period adjustments, the contingencies, the contingent expenses, the contingent gain, there are so many practical issues. But the level of knowledge, the expertise, like Pramodji already mentioned, the number of years of experience, 18 years, 10 years, I'm sure more than that, you would have more practical experiences which you will share today with all the members who are participating. So on behalf of ASB, I welcome both of you again. And of course, Jatinder Sharma ji being the moderator. And thank you again, sir, on behalf of ASB for being here, moderating this important session. And I'm sure participating members would really be benefited. And whatever the questions which comes in, of course, we'll take up those questions also in the end. And we'll try to compile all those questions when they are entered in the chat box, and then we'll try to compile and we'll try to take up as and when we have the questions being discussed over the next 2 hours. So thank you once again, Pramodji, and for giving me this opportunity. And we'll be there with you throughout this session. Thank you. Unmute kar lijiye, Pramodji. You said something. I missed the sentence.
I said thank you. Now over to the umpire, who is both the umpires as well as the third umpire, CA Jatinder Sharma ji, to take over the proceedings from here.
Thank you very much, sir. Thank you to the person who is the ocean of knowledge for all of us, CA Pramod Jain ji, the chairman of Accounting Standard Board, CA Abhay Chajar sir, who is vice chairman, Accounting Standard Board. At the outset, I would like to congratulate the Accounting Standard Board of ICAI for first time celebrating the Accounting Standards Day, 21st of April 2013. This celebration was grand. We have seen the participation of galaxy of past presidents and many panelists. That was a great discussion session on that day we witnessed. And I'm thankful, sir, for giving me this opportunity to moderate this session on accounting treatment for different types of contingencies and the impact of prior period adjustments on financial statements, which is covering AS4, AS5, corresponding Ind AS 8 and 10. So to start with, the first question of this session to CA Kaleshwara Prasadji. Sir, how does our standard define the term contingencies? Are there any specific exclusions from the scope of the standard for certain contingencies? If yes, please elaborate, sir.
Yes. So first of all, thanks to Accounting Standard Board, thanks to its chairperson and vice chairperson for giving this opportunity. When we talk about contingency, which is covered under AS4, so basically what happens is contingency here, it is covered as a residual pay. So it says that if it is not covered under any other standard, that is where this contingency comes into picture. So if you try to apply this to our contingency, contingent assets and liability provisions and contingent assets and contingent liability standard, so this contingent liability concept has been dealt in detail. Further, if I have to elaborate, you don't find this in Ind AS corresponding Ind AS standard. So even though it is AS4 and AS5, the corresponding Ind AS standard is basically Ind AS 10, which talks about this aspect, accounting policy change in accounting estimate and errors. So it does not cover the contingency. So basically, when we are talking about contingency in AS4, it's more of a residual coverage. That means if it is not covered under any other standard, that is where that would be covered under contingency. So having said that, contingency is basically a condition or a situation which should be existing on the balance sheet date, which should be existing, then only it becomes a contingent. A contingent is a condition or a situation, the ultimate outcome of which, whether it's a gain or a loss, will be known or determined only on the occurrence or non-occurrence of one or more future events. So basically, there should be a condition or situation which should be existent as on the reporting date or as on the balance sheet date. The outcome will be known at a later point of time or happening or non-happening of certain future events. Okay, so balance sheet date, it has to exist. That becomes a primary criteria. So further, this AS4 comes out with a few basic exemptions, which says that under following things are not covered under contingency. So basically, if you see that it excludes the liability of an insurance company, which they would have taken at the time of issuance of an insurance policy. The next is basically obligation and retirement benefit plan that is covered elsewhere. And the last being commitment under long-term lease contract. So these are the three exceptions which they have said in the standard. But to reiterate, kindly note that this contingency, what we'll be dealing or covering is more of a residual in nature, which has not been covered elsewhere. Say in accounting standard, we may not have financial instrument coverage. So accordingly, say, for example, if you're talking about provision for like debtors, so to an extent, so that might get covered here, but otherwise, very, very limited coverage as far as AS4 contingencies is concerned. Yeah, thank you, sir.
Thank you, sir. Very, very elaborative explanation, sir. Thank you very much. Sir, my next question is to CA Bhavesh, sir. Sir, what is the accounting treatment of contingent losses and contingent gains? How to determine the amount at which contingencies are to be included in financial statements?
Yeah. Thank you, sir, and good evening to everybody. Now, as you have given me the effect of the contingent losses and gain, I would like to address this in terms of an accounting format. Like as in when we say there is a loss, loss means there is a decrease in the asset and the increase in the liability. As well as if we say gain, there is an increase in the asset and there is a decrease in the liability. But here the word is coming that the contingent losses and the contingent gains, sir. Sir has nicely explained about the contingent. I would like to add one more point in that contingent, that this we are considering the loss or a gain of a future event. But that future event is also not under the control of the entity, because the entity is not knowing today what would happen. That would be the time that will tell that this thing is happening, which is resulting into a loss or a gain. So now, for example, like if I say in a company on which a claim has been lodged by any financial institution, customer, debtors, creditors, whosoever might be, and if the case has been filed, and if you expect the outcome of that case, which is against the favor of the organization, of the company, then they may provide this as a loss, and that loss we will name it as an contingent loss. But now the question will arise that on 31st March or on the reporting day, we do not know actually that this loss would happen or not. So we give an ability to go with the probability. What is the outcome probability? Is it more than 50%? If I say if it is yes, then we can book that loss and we can reduce our asset and create a liability by debiting to the profit and loss account. So this is one of the examples that we can take it for a contingent loss. One more example I would like to place in front of you. Like sometimes it happens that a fair has been organized by an institution, and under that various stalls would be available. And everybody would be paying for the some amount to get and book that stall. Now, a question would arise that as and when we say that it is an outcome of a future event, then whether it would cover a natural disaster or not. Tomorrow we don't know that earthquake will happen or not. Or my factory will demolish. So if you are being not sure, because that is not under your control as well, the same way like we have told that the court case is going, we don't know what decision would be given by the judge. In the similar pattern, this contingent would also include a natural disaster. If you can probable, and if you can estimate, if you can predict that if it is more than 50% and which would affect your assets and liabilities, then we may book that as a contingent loss in our books of accounts. But coming toward the contingent gain, we are supposed to give reference to a conservatism concept that if we are booking that contingent gain in advance, then that would overstate your revenue as well as the profitability. So for booking the contingent gain, they have restricted not to book unless it accrues and arise. At that time, you are supposed to record. But for a contingent loss, we are allowed to provide. Once again, I am repeating, if the outcome of that, which is going to happen in the forthcoming period, is more than 50% which you expect, then it is required to book that loss as a contingent. Thank you, sir.
Thank you, sir. Thank you. What we gathered is a situation should be existing as on the balance sheet date, the outcome of which, if it is likely to, there are chances of more than 50%, then only it has to be accounted for.
Yes.
And if there is any contingent gain, that we are not to provide into the books of accounts because that will inflate. Am I right, sir?
Yes, sir. Sure.
Thank you very much, sir. Thank you for nice elaboration, sir.
Yeah.
Sir, my next question again to Bhavesh, sir. Sir, what are the disclosure requirements in case of contingencies, sir?
Yeah. Now, in case of a contingent loss, you are providing in the books, but we have considered various factors. Now, how to reach to a conclusion that the outcome of this event would reach to more than 50%. Like if the court case is going on, then we are supposed to read out, we are supposed to elaborate, discuss with the lawyer, considering the case study, taking the opinion from the other expert if it is required, and we are supposed to reach to a particular fact that yes, considering this, we expect that the decision would be against us and we need to book that loss, whatever the outflow would arise. That is going to happen tomorrow. So for that, we need to give this base in our notes to accounts. That what is the base that you have taken for the outcome of this contingency, which is going to come tomorrow, that is after the reporting date. Amount that also we are supposed to ascertain, estimate, because it would not be actual. Actual amount would come to know as and when the case would get finalized. So nature, base, amount, what are the inputs that you have used in order to reach to the conclusion that the loss would happen in format of contingent loss, that would be sufficient enough to support that amount that we are debiting to our profit and loss account.
Sir, is this all methods which you said at this time to arrive at a figure of contingent loss, whether these all required to be mentioned into the notes of accounts?
No, the facts you may mention, amount may be calculated outside the books.
Okay,
amount
sir.
may be calculated outside the books because that would be running on through certain assumptions. So you are supposed to quote those assumptions on the basis of which you are reaching to this number. But the calculation would be sufficient enough. You may write just the total amount. But the reaching to that amount, assumptions, facts, inputs, that we are supposed to get it addressed.
Kaleshwar sir, any input from you on this point, sir?
See, as he has rightly pointed out, so if I have to just summarize, contingent liability is something which is probable, more likely than not. When the occurrence is greater than 50%, that is where you go with a conservative concept and you start recognizing it. So you have to disclose the basis of what is going to be the probability and what is going to be an estimated outcome of it. If you're not able to estimate, then the fact that why you're not able to estimate need to be provided. So contingent gain or an asset, they have taken slightly a stringent view, again following that conservative, where they have said not probable, but more of a certainty. Virtual certainty is the word what they're going to use. So virtual certainty is like very close to certainty. If you're talking 100% of certainty, virtual certainty is anything between possibility of occurrence is 90 to 95%. So ideally, you don't even disclose that contingent asset because the moment it is certain, you basically recognize it as a gain and that is how you record it in the books of account. It is more of recording it for contingent losses in notes to accounts, wherein the readers of the financial statements get a true picture of what is the probability which is hanging on the balance sheet as on the given date.
Thank you, sir. Sir, a related question, not on these accounting standards, just I have got a question in my mind that if the some contingent item is incorporated into financial statements, do we need to disclose it into 3CD report?
Okay. Yes, Jatin bhai. So basically, you have to see in the tax audit report. So one is that income computation and disclosure standard. In the income computation and disclosure standard, clause 13E and clause 13D is where you will have this differences which will have to be brought in. So there also, if you see, the weightage what they have given in relation to provision for contingency is slightly stringent. So the net effect of income computation and disclosure standard is basically to postpone the allowances or deductions or prepone the tax liability. In that context, the overall ICDC have been evolved or developed. So if there is a contingent liability, I don't remember the exact para of the 3CD, if someone can help me on that. So that is where you go and disclose, say, what is the contingent liability which we'll have to report. In addition, even in the audit report, if you remember, you also gave the possible litigation as on the balance sheet date in the last paragraph of your audit report. So that is the additional area where you will be disclosing.
Here, sir, I would like to have your comment on this, sir, because what we have read in the guidance note issued by an institute, only if amount is debited to profit and loss account, then only it has to be disclosed in audit report in 3CD para.
No, very right, very right. You know, if I talk about ICDS 10 is there, which talks about the provisions and related thereto. But if I talk about contingencies, then there is one clause which requires any contingent liability which is dated to the profit loss account. So the intention thereof is that what has been discussed by both the panelists is that such contingent liability, if it should be disclosed in the notes to accounts and not provided for in the books of accounts. So if it is provided in the books of accounts, then income tax department says that the income tax law says that it will be disallowed. So they are seeking a report from the tax auditor through the tax audit in form 3CA, 3CB, 3CD, where they said that whether the assessee has dated any contingent liability in the books of accounts in the statement of profit loss or not. So if that amount is filled, because sometimes what's happened is that contingent liability is disclosed in the notes to accounts and actually it is not provided. But few of the, I would say, assessees, they feel that whatever is given in the financial statement, because notes to accounts form part of the financial statements. So if it is given in the notes to accounts, they take out that figure from the contingent liability and put in that 3CD. So which results into lots of complications and additions made through processing of return under section 143(1) and all those things. So hence one has to be very careful that what is contingent, what is not going through this, and if it is contingent, then not provision cannot be made thereof, and it has to be disclosed in the notes of account and not fitted in the tax audit report 3CD.
So praxis, if it is not in profit and loss account, so need not to disclose in the 3CD.
No, not.
Right, sir. Thank you, sir. The next question is to CA. Sir, CA Kaleshwara Prasad, sir. Sir, what are the events occurring after the balance sheet date, and what are the types of event as per the standards prescribed? CA Kaleshwara Prasad, sir.
Yes. I'm just trying to share a PPT. So I've made a small PPT. Is my PPT visible?
Yes, sir.
So we are talking about events occurring after the balance sheet date. AS4 talks about events occurring after the balance sheet date. It talks about those significant events which happen between the date of the balance sheet, which is 31st March, till the date of approval. When we say approval, if it is a company, it is basically the board of directors. If it is any other body, then it's a governing body. So any such event which happened between the balance sheet date to the date of approval, we take into account, and then we go see whether those events require any adjustment to the balance sheet or it does not require any such adjustments. So this significant events could be further grouped into adjusting events or a non-adjusting event. The critical difference between adjusting and non-adjusting events are basically there should be a condition which should exist at the balance sheet date. If a condition exists at the balance sheet date, then only if subsequent events give rise to additional evidence to condition which exists at the balance sheet date, then it becomes our responsibility to go back to the balance sheet and make the required changes. Make the required changes in the assets and liability by recognizing corresponding income or loss as the case may be. If there is no conditions which exist on the balance sheet date, then subsequent event provide only a reference to it, then it becomes not an adjusting event. So that means, according to AS4, you don't have to make any adjustment to the balance sheet. It is sufficient, you only disclose it. I would like to elaborate it further. So first we have to see what do you mean by financial statements. Financial statements is the sum total of your balance sheet, your profit and loss account, your notes to account, statement of changes in equity, notes and significant accounting policy. All the 5 elements put together form part of your balance sheet. So that means if it's an adjusting event, you basically go and make a modification in any of these 5 components. That is where it becomes an adjusting event. Non-adjusting event does not require any modification to the financial statements. Now question comes, if it were to be so significant, how will I declare it? How will I disclose it? So they basically say if it is of such significance, which requires to be communicated to the users of financial statements, you are supposed to disclose it in the board of directors reports. report of an appropriate authority. So that is where we come into non-adjusting event. However, there are two exceptions to non-adjusting event. Basically, if it is provided by the statute. So basically, if there is a dividend proposed, fall under this category. And the next one is if it is going to impact your going concern assumption. So these are the two exceptions which falls under non-adjusting events. I've taken few examples as to what is adjusting, what is non-adjusting. Again, leave it to the moderator if you want to go deep into it. Say,
Yes,
for
sir,
example,
please.
discovery of errors or a fraud. A fraud has happened, an error has happened. That means the balance sheet which you have prepared that already comprises of this fraud, impact of this fraud or error. And later on, before the date of approval, if it gets noticed, then this becomes an adjusting event because the condition or situation was existing. And now the discovery of it is an additional evidence which is providing for you to go back and make the required changes. Impairment of an asset. Fall in the market price of an inventory. You may slightly find it difficult, but let me try to explain. Fall in the market price of an inventory. I have a closing stock. According to AS2, I would have measured it at cost or net realizable value, whichever is lower. So presuming that my net realizable value is greater, I would have still retained it at its cost. Presume that in the month of April, there is a sudden fall in the market price, which is going to impact your net realizable value. So that is where the condition, the stock was existing on the balance sheet date. You go back and make the required changes, re-arrive at the value of inventory, and that's how you make it as an adjusting event. Settlement of a lawsuit. So you have a court case or you have a dispute which is going on, which gets settled. So the settlement of which gives you a clarity as to what is going to be the outflow. That is where you go back and make the changes. Non-adjusting events, there was no condition or situation existing on the balance sheet date. So I have an investments. Luckily, we do not have a financial instrument standard in accounting IGAAP. So decline in the market value of investments, I wouldn't have measured my investments and a fair value. So I would have measured it at its original cost. So if there is a subsequent fall in the value of investments, so it is just a market movement. So I will not make the changes. I end up acquiring a business. I end up selling a business vertical after the balance sheet date. So there was no condition or situation existing on the balance sheet date. Change in the tax rate. Destruction of stock by fire. So presuming that there is a go down stock, fire happens and it destroys my stock. Presuming that this destruction happens after the balance sheet date. Presuming further that it is not of such magnitude which is going to impact my going concern. So that becomes a non-adjusting event. So what the standard AS4 basically says is it is sufficient if it is communicated to the readers of financial statement by including it in the board of directors report.
Thank you, sir. Thank you for such nice elaboration, sir. What we gathered is the adjustment is required for events occurring after the balance sheet date that provide additional information materially affecting the determination of amounts related to condition existing at the balance sheet date, and adjustment is not required if such events do not relate to any condition existing at the balance sheet date, right, sir?
Yes, sir.
Thank you very much, sir.
There are two exceptions.
Next question is to sir.
Two exceptions. So wherein even though it's a non-adjusting event, it becomes adjusting events. These are the two exceptions. One, if it is required by the statute, other, if it is going to impact your going concern assumption.
Right, sir.
Yeah, thank you.
Sir, next question is to CA Bhavesh ji.
Yes, sir.
Sir, how and in which case the breach of a material provision of a long-term loan arrangement can affect its classification?
Yes, sir. Now, reading toward this question, first, I would like to place, as sir has told about adjusting and a non-adjusting. So this example would relate to an adjusting event or a non-adjusting event. First, we are supposed to elaborate in that way because see, as and when we use the word long-term, so it is there for a more than 1 year. But here there is a breach is happening. Hence, the liability would arise on demand. I would repeat again. The liability would arise on demand due to the breach of a contract. So whether this would be treated as an adjusting event or a non-adjusting event, number one. And second thing is about the classification. So classification, we would like to address that whenever it is a long term, we would have classified this liability in format of a non-current format. So now whether we need to change that format from non-current to the current, that would be the presentation in the financial statement. So number one, first thing we will address as that this terminology would be treated as an adjusting event, and the whatever the provision is there, that would be created. Number two, that a classification, earlier the classification would have been under a non-current format. That also we are supposed to change it to the current format, because the liability might arise on demand format. That would depend upon the lender, because as you have breached the contract, so they might ask to repay the amount on demand. Hence, we need to change the classification also from non-current to current, and this would be treated as an adjusting event for a particular case. Thank you, sir.
Thank you, sir. Thank you very much, sir. Sir, my next question is again to Bhavesh, sir. Yes, sir. In case of deterioration of operating results and financial position after the reporting period, which may affect the going concern assumption of the entity, what is the position under different standards?
Yes, now in this case also you may take up an adjusting or a non-adjusting, where this can be addressed, like as in when we say operating results or a financial position after the reporting period is going to change and which might affect the going concern. So on a plain standalone basis, if I say if it is a going concern, then we are supposed to bring our financial statement on the basis of the realizable value. Number one. If it is not brought, then we are supposed to refer to the other standard also, which would tell us to bring the assets at this value, liability at the settlement value, and we are supposed to adjust all our assets and liabilities, provided it is the deterioration has been pointed out. It has been pointed out before the approving authority.
Great, sir. Thank you, sir.
Yes, sir. Thank you.
Next question is to CA Kaleshwara Prasad, sir. Sir, whether the fraud, it's a practical question, whether the fraud related to, say, financial year 2014-15 discovered after the end of the reporting period, but before the date of approval of financial statements for financial year 2016 and 17 is an adjusting event or not, sir?
Yes, sir. So basically, we have indirectly spoken about this earlier. So fraud or an error get noticed becomes an adjusting event. I'll tell you why it is. So in a case of 16-17 balance sheet, the impacted asset or a cash balance, as the case may be, might have already been valued and recognized as at its carrying value in the balance sheet. Now, subsequent to that, a fraud gets detected, which would have impacted materially the asset or the cash balance, as the case may be. So that is where you go back and make the required changes. So fraud in this case, which pertains to earlier period, which gets detected in the current financial period, you are supposed to take its impact. That means you are supposed to recognize the deterioration in the value of an asset or fall or the loss of cash, as the case may be, and you are supposed to make it as an adjusting event by recognizing the corresponding losses, as the case may be.
Thank you, sir. Sir, next question is to CA Bhavesh ji.
Yes, sir.
Sir, apart from the discussion which is held so far, is there any other major or important differences between AS4 and Ind AS 10?
Yes. Sir, as compared to the AS4 and Ind AS 10, we have seen that like AS4, I will just broadly categorize. Sir has also categorized into various two parts. One is adjusting and other is non-adjusting. So the effect of the adjusting under AS4 and Ind AS 10 is similar, that you are supposed to restate your asset and liabilities. But coming towards the non-adjusting factor, that is also a material non-adjusting factor, then AS4, because Non-adjustment means we are not adjusting the asset and liabilities. Hence, we are just reporting somewhere. If we are not adjusting asset and liability, but we want to report this event in our statements. But where we are reporting under AS4, it was been reported to the approving authority report. That is, we considered as a board of directors report. But Ind AS 10 has certain changes in that they want that if non-adjusting event material in nature, then you should include as a part of the financial statement. We are not supposed to give effect, but we are supposed to disclose in the notes to accounts of the financial statement. AS4 was requiring that to be disclosed only in the board of directors report. That is the major change in terms of the disclosure of the material non-adjustment event.
Very nice, sir. Thank you, sir.
Yeah, thank you.
Sir, my next question is to CA Kaleshwara Prasad, sir. Sir, how are prior period items disclosed in the financial statements?
See, for this, we need to first understand what are prior period items. So prior period items are basically income or expenses which arise in the current period due to error or omissions in the preparation of financial statements of one or more earlier financial period. So basically, we have done some mistake, some error, some omission, which is intentional or otherwise, in the earlier financial period. If that gets noticed or corrected in the current financial period, then it is called as a prior period items. Okay. One important thing in the prior period items are basically prior period items does not include circumstantial necessitated adjustments. What do you mean by adjustments which is necessitated by way of circumstances? Say there is a revision of wages. Say there is a increase in tax liability. Okay. So there is a revision of wages of earlier financial period, which none of us were able to estimate it. So that increase in wages is basically increase necessitated by way of circumstances. So this is kept outside the purview of prior period items. So prior period items are only those income and expenses which arise in the current period because of error or omission. If there is a change which necessitated according to circumstances, that would be kept outside the purview of prior period items. Okay. So now the question is, how will be disclosed in the financial statements? Prior period items will be disclosed on the face of the profit and loss account separately, so that the readers of the financial statements can pursue the meaning of or pursue the significance of prior period items, which is incorporated in the financial statements.
Thank you, sir. Thank you very much. Sir, next question is again to you. What are the impracticalities in respect of prior period items, retrospective application and retrospective restatement?
Yes. So here I would like to slightly take an additional time. So what happens in case of prior period items under accounting standard? They only want effect to be given prospectively. So they're not talking about retrospective effect. However, in Ind AS, we basically go back and give a retrospective effect. So retrospective effect is basically we go back to the earlier period. If the changes is impacting only my last year, I restate my last year. If it is impacting my period prior to last year, then I basically go back and prepare a third balance sheet, restating the asset, liability, and giving the corresponding changes to other equity and the retained earnings. So this is one important change which we notice in Ind AS and accounting standard. Accounting standard only talks about disclosure and changes in the prospectively, but Ind AS talks about retrospective effect and retrospective adjustment. So in this context, your questions become important. So what are the impracticalities? So just let us dwell deep into it. Presume that there is a prior period error. So which would, if you are doing the financials for financial year 22-23 and you notice there is an error, that means a fixed asset have ignored to be recorded. And that fixed asset was added way back in say 2014-15. So retrospective adjustments want you to go back and identify its effect till the beginning of the previous financial period and try to give that effect in the third balance sheet. So there is a significant time and effort gets involved if you want to give a retrospective effect. So further, if that historical data is unavailable, if the historical data is incomplete, so then you will not be able to give a complete retrospective effect. So this additional time lag, additional cost basically would delay your end result, which is basically the current year financial reporting. Again, sitting today, if you want to go back and see what would have been your step in 2015-16, so that involves a significant management judgment and management subjectivity. So someone today is basically evaluating his past thing. So it basically comes with lot of subjectivity, lot of judgment. And the other important thing what I would basically see is whether this effect is going to be relevant to the users of the financial statement or is going to be irrelevant. So this is again a subjective question which management has to think over. Doing all this, will it actually going to improve my financial visibility or is it not going to be relevant? The last one, I would rather say it's a legal implication. Say, for example, earlier, because of my presentation, I had a debt equity ratio. I had a favorable financial ratios, which I had submitted it to the banks and financial institutions. Now I noticed that there was an error. And because of that, if I want to restate, my earlier period ratios, my earlier period financial position might have a different picture. I would have actually given the previous financial statement, submitted everything to the bank. Now, if I'm going to restate, if I'm going to do a retrospective effect, so what is going to be the legal implication? What is going to be the practical difficulty? How you are going to convince your banker? Because banker would require quarterly, monthly financial statements. So all these are the practical difficulty what I foresee in case of retrospective adjustments.
Thank you, sir. Sir, one more question is coming to my mind relating to prior period. Amount of GST which is already paid, like in say in 2020, right, sir? And that is required to be reversed today. Will it be prior period item, sir?
Again, you will have to see, sir. So I clearly gave you while discussing the prior period items. This does not include adjustments necessitated by circumstances. Okay, so now we'll have to put your question into this yardstick and see whether it has resulted in circumstantial requirement or not. So at that point of time, since the law was vague, law was not clear, you took a conservative approach, you accordingly recognized the provision, which in today's context, because of your improved, because of your knowledge and the observation, you might foresee that that particular provision might not be required. So I don't think that is going to covered under prior period item. It is purely required according to the circumstances.
Thank you, sir. Sir, I seek the permission of both the panelists. The questions related to the topic being discussed, should we take those questions right now or we can keep it for later part of discussion, sir?
Sir, I suggest, because there are certain questions which we will still be talking, discussing and deliberating. So most of the questions might automatically get covered. So let us cover the questions, and toward the end, we have ample time to take up questions from the audience.
Fair enough, sir.
Yeah, that would
Thank
be
you. Thanks for considering.
Thank you. Thank you. Next question is for CA Bhavesh ji.
Yes,
sir. What are the limitations on the retrospective restatement of financial statements with respect to errors?
Yes. See, now, as and when the error comes, so the error which has already happened in the past, we come to know today that we have made one mistake. Now we want to rectify that mistake. So now the question will arise that today I am preparing a financial statement where for maximum how many years I am giving the financial statement of 2 years, which is the current year and the preceding years. So this Ind AS has told that if you have made a mistake in the current year, there is no, because you have not released the financial statement, make the changes. You have made a mistake in the previous year, then still today you have a chance to rectify those mistakes in the previous year, you may present it. But what about the errors which you have made in the past And in the past also, like if I say company has thought that I would like to change the policy which I have made 20 years back. So this is a limitation, no, to take back the values from the 20 years, reaching to this number. So that is why this Ind AS has divided these errors into two parts. One is it a period specific? That means you know the year in which the error was made, rectify it. If it is a cumulative means like if you have made an error before 2 years back, because we have a financial statement of 2 years, then you have made an error in the past, then the effect of that would be coming every year to each and every financial statement that you have prepared. But now the limitation is there. We can't change the previous year's financial statement. So what we are supposed to do, let's take a cumulative effect of all those errors. If I would have removed those errors, then this is the effect which I need to give to the financial statement. That effect prospectively I will give it, changing my opening P&L or opening retained earnings, and second effect I will give it to the respective asset and the liabilities. So they have divided into two parts. Again, I'm telling period specific and one is cumulatively. Limitation is there for the cumulative purpose. For each year, I may give it to the respective periods.
Right, sir. Very nice, sir. Sir, for you mean to say for cumulative things, we need to make one adjustment prospective, not retrospective.
Yeah, prospective means we are supposed to take the cumulative effect, like a depreciation to be charged higher. So that I will adjust to my retained earnings, which I am showing to the beginning of the preceding years. And the effect will be taken to the asset and the liabilities. But if I made an error in the last year only, then in the current year, I may restate that preceding year's financial statement, and accordingly, I can release the current year's financial
statements. Thank you, sir. Thank you. Sir, next question is again to you, sir. What is the change in accounting estimates, events that result in change in accounting estimates? Also, please discuss the effect of change in accounting estimate on the profit and loss of an entity.
Yes. Now coming towards an estimate, so to a wider note, we can say an estimate where we make an estimate, like in providing for the bad debts in the debtors. So that would change upon, because our debtors aging, the components of the debtors would be every year it would be changing. We would be changing our assets if we are supposed to bring our assets and liabilities to the fair value. So that fair value also is changing. That also we will take it as an accounting estimate. Like for an example of a warranty obligation for electronic products, which generally a warranty is being given, and you take an estimate that this would be the liability that would happen. So all these kind of changes which are happening, those changes generally, and we are supposed to give an prospective effect, and we are supposed to charge it to the profit and loss account. Like last year, I might have made a provision of 10,000. Now I would like to make a provision of 12,000. So that increase of 2,000, I will provide in the current year, and I will not change the previous year's financial statements. So that 2,000 effect would be provided in the face of the P&L account.
Thank you, sir. Thank you very much, sir.
Yeah, thanks.
Next question is from to CA Kaleshwar Prasad, sir. Sir, what is the change in accounting policy, and how is it disclosed in the financial statements?
Yes, in fact, this actually interests me. So what is accounting policy? First, we need to understand what is accounting policy. Okay.
Yes, sir.
So is accounting policy same as accounting standard? Accounting standard basically is, if I have to put it in a very simple terms, it is basically a rules framed for the which need to be adhered to while preparation and presentation of a financial statements. Accounting policy is the entity way of adhering to the rules. So accounting policy is basically a method, practices, principles used by the entity in preparing its financial statements. Having 12 months financial statements is an accounting policy. Following a particular method of inventory valuation, FIFO method or a weighted average method is an accounting policy. Or you can elaborate it. So basically accounting policy is when you have alternatives you choose one of the alternative and you present it consistently between period to period so that there's an uniformity within the entity, and even it helps the entity to compare with other entity. So that is going to be an accounting policy. Now the thing is, what leads to change in accounting policy? So AS has given its own thing that only under the possible circumstances you are supposed to change the accounting policy. The first is basically if it is required by a statute. The second is if it is done in compliance with accounting standard. The third is it's a management discretion. If it results in a more appropriate presentation of financial statements, so that is the time only under these three circumstances you are allowed to change your accounting policy. Okay. What is the disclosure requirement? So the disclosure requirement is if you are changing an accounting policy, so the first thing is if it is having a material impact in the current financial period, you disclose what is the material impact in the current financial period. It may so happen that you may not be able to ascertain the material impact, then disclose the fact that why you are not able to ascertain the material impact on the financial statements. The third scenario is it is not having material impact in the current financial period, but it is going to have a material impact at a later point of time. Then you disclose the fact that it is going to have an impact in the subsequent period and not having any impact as on the financial statements. So this is the disclosure requirement under accounting standard. If you want to elaborate it to Ind AS, again, change in accounting policy requires a retrospective application. So Ind AS 8 read with Ind AS 1 talks about retrospective application for accounting policy. That is where there is a necessity for us to prepare a third balance sheet if it is having an impact in the earlier financial period. Thank you, sir.
Thank you very much, sir. Thank you. Such nice elaboration on this, sir. Next question is to Bhavesh, sir. Sir, are individual entities within a group required to adopt uniform accounting policies in their standalone statements?
Yeah, as we have discussed about the group. So let me take just a small example of like CFS, and we have a subsidiary, we have associate, and we have a joint venture. So everybody is preparing their separate financial statement, and at last a parent company would club all this financial statement. So the question before us arises that all those small entities which are within the group are following our accounting policy or whatever is the policy which they have made. Then the same type of policy has to be followed at the time when you prepare a consolidated financial statement. Question before us is this. So our accounting standard 5 has clearly told that all the individual as well as the group is supposed to follow a uniform accounting policies. But Ind AS 8 does not require that uniform accounting policy is a must. Individual entity, subsidiary is there, associate is there, joint venture, whatsoever the entity are there, they may follow their own accounting policy to prepare the financial statement. But at the time when it comes to the group, while preparing the consolidated financial statement, then a group will give an effect of changing their accounting policy to the group accounting policy, and they will prepare the consolidated financial statement. And whatever the effect will come, that would be recorded only in the consolidated financial statement. But there is no such restriction, there is no such limitation is there on the individual entity to follow that everybody must follow the same accounting policy. That liberty is available under Ind AS 8, but that was not available under AS 5.
Thank you, sir. Thank you. Really very nice, sir. Prasad sir, though you also have touched this difference between AS 5 and Ind AS 8. Something little more on this you want to say, sir?
Very good, Bhavesh pointed out. In addition to that, few differences which we have dwelt earlier. Ind AS 8 talks about a retrospective application. Whenever there is a error or whenever there is a change in accounting policy, it talks about retrospective application. Accounting Standard 5 talks only about a disclosure of those thing. So there is no concept of retrospective application and accounting standard. So that's the first thing what I would like to elaborate. The second thing is when we are talking about prior period, so when we are talking about net profit or loss for the period extraordinary items, there's something called as an extraordinary item which is dealt in AS 5. What are extraordinary items? Because of its nature and impact, if it needs to be presented separately, then those are called as an extraordinary items. Accounting Standard 5 does give few instances. The first is basically loss due to natural disaster, say earthquake or a flood as the case may be. The second is attachment of a property by government authority. The third one, which is I would rather stress upon, is a refund of a government grant. So even the refund of a government grant, AS5 says that it is an extraordinary item. However, when it comes to Ind AS, this extraordinary item, line item has been excluded. So you do not find this extraordinary concept under Ind AS. So there is only ordinary line items. If ordinary is of such importance, then that might have to be presented separately, but there is nothing called as an extraordinary item. The third is, if you are developing a accounting methodology, which was previously not been followed, Ind AS gives you a hierarchy as to how you're going to develop. So first it will say you have to refer to the recent pronouncement of IASB. If not, you go to any other pronouncement from other body. So it gives you a hierarchy which you have to exhaust then to develop or evolve your accounting practices. So you do not find that explanation in Accounting Standard 5. So these are some of the important differences which I find I wanted to elaborate on. Thank you.
Thank you, sir. Sir, one more question similar on disclosures. If change has no material effect, though you have touched this question also, if change has no material effect on financial statements of current year, but there are reasonably expected to have impact on later periods, in which year this is to be disclosed?
You're supposed to disclose the fact in the current year that it is not having an impact in the current financial period, but it's going to have an impact in the future period. And in the future period, you're supposed to disclose its impact on the financial statements. So the fact, disclosure of a fact in the current financial period would suffice.
Thank you, sir. Bhavesh sir, next question is to you, sir.
Yeah.
Sir, the difference between actual expenses or income and the estimate expense or income as accounted for in earlier year's account does not necessarily constitute an item to be a prior period item. Your comment on this, sir?
Yes, sir. For that, sir, I would like to take one numerical numbers values where, like, I will take an example of a construction industry. Like if I say my financial year is 21-22. Under the construction industry, we know that we do not incur all the cost in the current year because the project is going to run for more than 1 year. So like for a financial year 21-22, assume that the actual cost which I incurred is assume 100 rupees are in crores. Is my screen is visible now to everybody?
Yes, yes.
Actual cost is 100 rupees, 100 crores I have incurred in financial year 21-22, and I am estimating a further cost. To happen is 50. So I will make a total here, writing that my total estimated cost will become 150 crores, which I was estimating at the time when I have prepared financial year 21-22 financial statement. 100 is actual, further is 50, and total estimated cost is 150. Now, I have come to the current year, assuming the financial year 22-23. Financial year 22-23, the actual cost which I have incurred is assume 110. And now I am estimating further cost to happen because my project is not yet over. It is also going to run for more than 1 year still. So assume that I am estimating 70 rupees of cost. So my total cost is 180.
80.
So now if I say that 150 you were estimating, which has become 180. So your estimation has increased by 30. Actual costs are happening that we are debiting to the P&L account. So now in financial year 22-23, this is my current year. Can I say that the mistakes which I made in estimating my cost would be treated as a prior period item? Because this is a mistake I have made, no? Because last year I have estimated that my total cost would be 150. Now I am estimating 180. The format of calculation remains the same. Last year when I did, my total cost of the project was 150. In the current year, I am expecting my total cost of the project is 180. So in the current year, can I address that I have made a mistake in the last year? If this question to this answer is yes, then we can say it is an error is been made and we are supposed to rectify. If it is not, then it will just go only with the estimate and it would be treated as an accounting estimate and you may continue recording 180 in the current year, 150 in the separate financial year. So this is my actual, this is my estimate. Sir, here, can we raise certain questions to the attendees and can those people answer that facility is available? That this would be treated as an error I have made in 22-23 or it is an estimate. If this example is there in front of us. Sir, is there possibilities there like question answer if the communication is possible? Or if some people are interested to answer.
Chat box. Shalini ji can tell better.
No, they won't be able to answer because it is a broadcast.
They won't be able to answer, sir. Won't be able to answer.
Okay. So the standard says that whenever you make a change in the estimate, so before that, first we are supposed to identify that yes, this is an estimate, it is not an error. Financial year 21-22, I have not made an error in wrong estimation of 30. At that time, the situation and the conditions were prevalent such that I have estimated the total amount of 150. And in the financial year 22-23, I have estimated a total amount of 180 and 30 I will provide additionally. So this would be treated as a normal estimate and the effect would be taken prospectively and it will not be taken retrospectively considering it is an error. So the question arises before us that the estimate and the actual. Question before us arise, it is an estimate or an actual. So actual is this, estimate would be this. Change would happen in the estimate. We are supposed to identify that the amount which is changing, my total amount, that would be identified as an error of the previous year's financial statement or it is just an estimate so that I can continue giving effect prospectively. So for this example, the change which is happening from 150 to 180 would be treated as an estimate and effect would continue prospectively. This would not be treated as an error. Sir, I hope I have properly placed the numbers in front of everybody.
Absolutely, sir. Very nice, sir.
Yeah. Thank you.
Thank you, sir. Thank you. Sir, next question is to Prasad, sir. Sir, while preparing the annual financial statements for the year ended 31st March 2023, an entity discovers that a provision for constructive obligation for payment of bonus to selected employees in corporate office, which is material in an amount, which was required to be recognized in the annual financial statements for the year ended 31st March 2021, was not recognized due to oversight of facts. The bonus was paid during the financial year ending on 31st March 2022 and was recognized as an expense in the annual financial statements for the said year, meaning thereby for financial year ending on 2022. Sir, question is, would this situation require retrospective restatement of comparatives, considering that an error was made and it was material?
Very good question, sir. So basically, we are doing a financials for year ending 2023, wherein for year ending 2021, there was supposed to be a provision which we are supposed to make, which we have not made. So if it were to be a provision, ideally, what would have been the correct entry? You are supposed to make a provision in 2021. That means it would have got accounted as an expenses in 2021. And when you make a payment, that provision would have got nullified in the year 2022. But in reality, what has happened is no such provision is made in the year 2021. That means expenses to that extent is understated. In the year 2022, they have accounted it as an expenses and have actually paid. So if you look at balance as on 31st March 2023, it is not going to impact because as on 2022 itself, the liability is squared off. Okay. Now the question is it a prior period error? The answer is, in the year 2022, there is a change. There is an impact on the income or expenses on account of entries pertaining to earlier period. Because of not accounting provision in the year 2021, you end up accounting an expenses in the year 2022. So it's an apt case for prior period errors. So if you basically see 2023, there is no impact. Neither the balance sheet nor the P&L account is undergoing a change. But the disclosure requirement of prior period clearly says that if there is an error, I'm talking about Ind AS context, if there is an error of prior period, it requires a retrospective restatement in the first set of financial statements approved for issue after the discovery of mistakes. In the first set of financial statements, after the discovery of error, so you're supposed to disclose it. So now we have discovered it in the year 2023. So you mandatorily have to restate the comparative amount of a prior period in which error has occurred if it is restricted only to the last year. So in our case, it is restricted only to the last year. We are supposed to restate it. If it pertains to earlier period, then you end up preparing a third balance sheet by restating the asset liability by giving a corresponding effect to retained earnings and other equity. Yes, sir.
Thank you, sir. Thank you very much.
Yes.
Bhavesh sir, next question is for you, sir. Assume the subsequence to the year end and before the financial statements are approved, company's management announces that it will restructure the operations of the company. Management plans to make significant redundancies and to close a few divisions of company's business. However, there is not formal plan yet. Should management recognize a provision in books if the company decides subsequent to the end of the accounting year to restructure its operations, sir?
Yes, sir. It's a long question, but the answer is very small. Like this, no, I would like to give reference to the content of like non-current assets held for sale. There is also one Ind AS is there that sometimes you decide that I want to sell one of my assets from the balance sheet. That you decide only. So on the basis of your decision, I can't remove the asset from the balance sheet. But if you are concretely deciding, you are very conscious on the decision about that, yeah, this asset is going to be sold by me in the upcoming future. With that intention, if you are thinking, no, then we are supposed to ignore everything. That why you are thinking that you want to sell the asset. Is there a solid reason is there that your business operation is not running well or you want to replace the asset? What is the reason behind for removing that asset? What is the reason behind removing that division? Now, in our question, we have like, I want to shut down one of my division that might not be a profitable one. But are you serious enough to give effect to what you are thinking about, that I want to close the division? Then there is a standard is there separately, non-current asset held for sale. They have told immediately what you are supposed to do it. Remove that asset or remove all the assets belonging to that division from the basket of fixed assets and give a new name, new identity, that these are the assets held for sale. I am not selling now, but I am very much conscious about it, that I would like to sell this asset. For this, he is supposed to convince the auditor. For that, we are supposed to get convinced that, yeah, really they want to sell. Hence, let's remove from the fixed asset basket and stop charging and claiming depreciation on that. But this would happen on 31st of March. Question before us arises that if this event is going to happen after 31st of March, can I take it as a subsequent event or not? And should I adjust in the similar pattern as it was being given effect under the non-current asset held for sale? So same way here also, sir, we are supposed to see the consciousness of the management. They want to really shut down the unit. For that, how to verify this? You could take an board's approval if they have seriously decided, or they have found out the vendors or the buyer who would like to purchase this division. They have given an advertisement in the newspaper. They have asked for an agency to take up their division. If this kind of evidence are coming before you and you are getting satisfied, you means as an auditor, we are getting satisfied that this management is serious, conscious about to sell this division, then we may take an exit from the classification of the fixed asset, and it would be shown separately under the identity name as assets held for sale, and the valuation would be followed as it is given under the Ind AS non-current asset held for sale. But again, I am repeating at last on a conclusive format, there has to be a seriousness from the management about the removal of this division. Then only we are supposed to give effect, else or separate note you may give it, but the effect in the financial statement would not be given.
Fair enough, sir. Thank you very much, sir. Very elaborative answer, sir. Thank you. Kaleshwar sir, next question is for you, sir. X Limited was having investment in form of equity shares in another company as at end of the reporting period, that is 31st March 2022. After the end of reporting period, but before the approval of financial statements, it has been found that value of investment was fraudulently inflated by committing a computation error. Fraudulently inflated by committing a computation error. Whether such event should be adjusted in the financial statements for the year 2021-22.
Yes, sir. I think it goes back to adjusting events and non-adjusting events. So the thing is, there was an investment which was existing on the balance sheet date for which we have ascertained the value. But unfortunately, that value have been manipulated with a fraudulent intention. So that fraud we have identified before the date of approval. So hence, it becomes an adjusting event. We'll have to go back and recompute the value of investment and correctly stating the investment by recognizing the loss in the year ending 2022. So the answer is it's an adjusting event because there is a condition or a situation which was existing on the balance sheet date and that got altered because of the fraud. Yes, sir.
Thank you, sir. Thank you. Bhavesh sir, next question is for you.
Yes.
Sir, we seek your words on major differences in Ind AS with IAS 8, sir. Ind AS 8 with IAS 8, sir.
Okay. Yeah, in context to that, I would like to just write up something about the IAS 8 and we have Ind AS 8. It is just in format of some 2-3 points are there. Majority I would like to highlight. That is just giving the naming part. Like IAS uses the word balance sheet. Ind AS 8 is using the word statement of financial position. Again, if you come to this, they are using the word profit and loss. Here, they are using the word called as a statement of comprehensive income. And as and when we are using the word that events occurring after the balance sheet date and all this thing, we are taking an approval of the management. So we are taking an approval of the financial statement by the board. So board will give approval and then it goes to the auditor for the finalization. So here in the Ind AS, they are using the word at that time of using the standard is approval of the financial statement for issue. Approval of the financial statement for issue, and Ind AS 8 is using the word authorization of the financial statement for issue. So authorization is coming here. Here they are using the word approval, and the balance sheet and the P&L, they have a different format to different name to be used at the time when they are addressing the financial statement position. So according to me, on a brief summary, we can say these are the major differences that would arise between IAS 8 and Ind AS 8.
Thank you, sir.
Yeah.
Thank you very much, sir.
I hope that screen is visible, no, to everybody. Sir, is visible?
Yes, sir.
Yes.
Yeah.
Perfectly visible, sir. Prasad sir, next question on similar lines for you, sir. Sir, please elaborate major differences of Ind AS with IAS 10. Ind AS 10 and IAS 10, sir.
Yes, sir. Yeah. So basically, it's events occurring after the reporting period. Events occurring after the reporting period. The beauty is, Ind AS 10 talks about reporting period. IAS calls it as a balance sheet, which is on par with our accounting standard. So accounting standard as well as IAS talks about balance sheet date. Here we are referring to, in Ind AS, we refer to that as a reporting period. So events occurring after the reporting period. So basically, which is a balance sheet, but we call it as a reporting period. So this is one, again, difference with respect to the way it has been, wordings have been used. The second thing is with respect to the accounting treatment for dividend proposed. Dividend proposed, whether it's equity dividend or a preference dividend. Ind AS 1 has a specific requirement that it has to be disclosed in notes to accounts. So it becomes a disclosure in the notes to accounts. There is no such similar requirement under IAS. Okay. The third differences is basically adjusting events are further grouped into significant events are further grouped into adjusting events or non-adjusting events. And we have given equal importance for adjusting and non-adjusting events. As we have discussed it earlier, even if it's a material non-adjusting events, we end up disclosing it in the financial statements. That means you basically go back and add it in your notes to financial statements. That's what we do even in case of a material non-adjusting events. Okay. However, in IAS, it is much narrower in scope as it concentrates more and more on adjusting events and very little with respect to non-adjusting events. And even when it comes to a disclosure aspect, it is more stresses on the adjusting events and gives very little importance for non-adjusting events. The other thing is basically a carve out which you find it in Ind AS, which we had previously discussed. I think in repetition, I may just have to repeat this. If there's a breach of material provision of a long-term arrangement, say I had a long-term arrangement with the financial institution, there is a breach of a covenant, there's a breach of a condition that has made the long-term arrangement as short-term arrangement. That means it has become, the loan has become repayable on demand. So what was long-term, now because of the breach of covenants, that has become repayable on demand. So this has happened as on the balance sheet date. Now subsequent to the balance sheet date, both the borrower and the bank agree to a terms, and then the bank says that no, I will not demand it. That means I'm not going to make it a short-term liability. So even though it has happened after the balance sheet date, it takes the nature of an adjusting event, and accordingly, we will still go ahead and classify this. So this is one carve out what you find it in Ind AS 10. So these are some of the major differences between Ind AS 10 and IAS 10. So, thank you.
Thank you, sir. Prasad sir, there are a few questions in the chat box. If you permit, may I proceed, please?
Sir, we can take up the questions now. One by one, we can take up the question.
Yes, sir. Sir, first question is, at the time of giving effect of prior period errors on earliest previous year, probably earlier previous year balance sheet, that is 31st March 2022, then in which date we have to pass the JV for the same as per Ind AS 8. It means earlier period 100% compliance of Ind AS has not been made, then how to give the effect in auditor's report and IFSC report?
Okay. So let me read the question again 1 minute.
So you can open the chat box, please.
See, the question is, this has been identified as on year 2022. So in the year 2023, when we are actually preparing the financials, we have noted, I think this is a continuation of the question what we had discussed earlier. Error of earlier period has got noted in the year 2022. So we basically make an adjustment while preparing. So we basically make a comparative period adjustments, which is submitted along with the current year financial statements. So the comparative last year is the one which gets modified to accommodate the prior period errors and the requisite disclosure what you give it in the notes to accounts. Okay, so I don't think this is going to have any impact as far as the previous year audit report and IFSC report is concerned. Okay, unless if it is of a fraud, then the different standard auditing standard comes into picture where we'll have to comply with that.
Thank you, sir. Bhavesh sir, next question. In case a major loss occurred after the adoption of accounts by the board, which substantially affect the financial statements, should the auditor report it?
Yes, now, sir, for that, like if I draw up a timeline, then I can say a 31st of March is the last day of closing the accounts, and the audit starts after 31st of March. And here the BOD approves the accounts. After approval, auditors gives report. And after auditors report, the directors will come and directors report. So can I say the directors report will be the last document that would be released for a particular financial year? Like if I say 31st March 22, then financial year 21-22, this is the last report that would be released for that particular financial year. Now, the question is coming here that after the board of directors has approved and the event has happened here, and then that event should auditor report in their financial statement for the financial year 21-22. I hope the query is this.
Yes, sir.
Yes. So now the question will come that about the standard is talking about an adjusting and a non-adjusting event. So an adjusting and a non-adjusting event are supposed to be given effect provided that event is happening after 31st of March and before approval of board of directors. So event must happen here, then only you are supposed to identify that it is an adjusting or a non-adjusting. Once the event is happening after the board of directors have approved, then there is no question of identification that it is an adjusting or a non-adjusting, because the standard does not apply. But the question comes here because it has made a heavy losses, and it is a question on their going concern. Exactly. It is a question on their going concern. Hence, the question is coming that whether auditor should give effect here, even if the event is happening between these two periods. then according to me and the standard, that if it affects the going concern, then it must be given. If it affects the going concern, then only. But now I would like to add a question on that question, that if the event would have happened between auditor's report and the director's report, and it is affecting going concern, then what we should do? I hope I am with the correct timeline with everybody.
Absolutely, sir.
Here
Absolutely.
we have a scope. Here we have a scope because the auditor's report is not yet released. But for that, there is not a standard is available to identify here that are you an adjusting or not adjusting. Because the trend has been missed after the BOD has approved the report. But if it is a question of going concern, then we may include it over here. But if the going concern is affecting after the auditor has released the report, but directors has not given the report, then now auditor will have a scope to give it report only in the next year.
Perfect, sir. Perfect, sir. Very nicely elaborated, sir. Thank you very much.
Thank you.
Sir, next question is, if during scrutiny, the GST officer finds sales invoice or purchase invoice not recorded in running statements, and the client accepts the undisclosed sales, do we need to include the same in regular books, or how should the treatment go? I think period is not mentioned into this. If during the scrutiny, the GST officer finds sale invoice or purchase invoice not recorded in running statements, and the client accepts the undisclosed sales, do we need to include the same in regular books, or how should the treatment go?
Can we slightly modify this question saying that the GST assessment is happening, and during the assessment, the assessing officer has identified an additional liability to be paid? Say, for example, for financial year 21-22, assessment is happening in 22-23, and the assessing officer has identified an additional liability to be paid. So, will that be okay?
Yes, sir.
Sir. So it is going to be. So it will not fall into the prior period errors for that matter. So unless
no, Kaleshwarji, here the question would be that there was a survey and they found certain invoices which were of the prior period and not recorded in the books.
Okay.
Assuming that after 31st of March and before the board of directors have approved, the survey has happened.
Yeah.
Let's take the particular timeline. After 31st of March and before the board of directors have approved, the survey has came. That is after 31st March, and they have found out certain amount of sales invoices. Then considering as an adjusting or a non-adjusting, we can take it that sales or not. We don't know the survey has happened. When that survey has happened?
Survey has not. Suppose the survey has happened after the
timeline, it would be more. If you can add on timeline, it would be more easier to analyze.
Suppose it has happened after the board of directors approval.
And before auditor's report has released.
Suppose. No, after the board auditor's report.
After
so that's why that's why the question comes. Then in the next year they have to account for that invoices.
Okay. Say for financial year 21-22, certain invoices have been missed out. Okay, that we have noted after the approval of financials for the year ending 22. Am I correct?
Yes.
Yeah. So then it fits into prior period items, sir. So because this is something which has happened by of an omission or an error, which we have noted in the subsequent year, which is financial year 22-23. So then the prior period, it will fit into the prior period ambit, and we'll have to go according to the requirement of prior period errors.
And if it is prior to the finalization of the financial statements, then it ought to be accounted for in that financial year itself.
It becomes an adjusting event, sir. Yes. Pramodji, correct me. So continuing the same example, financial year 21-22, invoices have been left out. Those have been identified in the month of May before the approval by the board. Is that your question?
Yeah, yeah.
Then it becomes an adjusting event. We'll have to go back and make a necessary adjustments.
Great. Thank you.
Thank you, sir.
Sir, next question is whether change in method of depreciation is considered as change in estimate as per revised AS 10?
Yeah, keep small and simple question for me. Whether change in the method of depreciation is considered as a change in estimate as per revised AS 10, the answer is true, correct. Earlier it was being treated as a policy, but now it has been changed to an estimate.
Great, sir. Thank you, sir.
Thank you, sir.
If I just have to add on, it is still a change in accounting policy, but the accounting effect will be on par with change in accounting estimate.
Okay.
Yes, sir. Sir, next question. The jeweler company wanted the staff to work on all festival dates and asked them to compensate on other days. The staff in subsequent year requested to compensate financially for the work done on holidays instead of taking off on other days, which management agreed in subsequent year, whether this amount to prior period expenditure or current year expenditure.
Sir, I think when we were discussing prior period items, we also discussed something called as changes necessitated on account of circumstances. This is something that there was a negotiation which was going on, similar to revision of wages of earlier period. I think that revision of wages or the discussion has got materialized in the given financial period. So it will not fit into the prior period item, sir. It will be accounted as an expenses of the respective financial period.
Very nice, sir. Thank you. Sir, Bhavesh sir, next question for you, sir. Whether advance taken for asset held for sale, which is a land, needs to be disclosed as current liability and not a non-current liability, which is required for advance taken for capital goods.
Advances taken for asset held for sale, which is a land, needs to be disclosed as a current liability and
not a current liability.
Non-current liability, which is required for advance taken for capital goods. Yeah, generally a land which you are going to held for a sale, if it is going to get materialized within the 12 months, then we can treat it as an advance. It will not be treated as a liability. And there is a substantial that agreement for sale also would be followed with that advance. Else we are supposed to record it as a liability. Like in a construction industry, the money that we receive from an contracting in context to the advance, that we are showing as a liability, or we are deducting from the capital WIP, because we don't know the certainty that the construction would get completed. If it is more than 60%, more than 70%, then it may be taken into a revenue. But if you are going to take up land for a sale, substantiated with an agreement for sale within a 12 months, then you may treat it as an advance and not as a liability, whatever the advance that you have received.
It could be, if we talk about,
yeah,
it could be various different aspects. It could depend upon the activity of that company. It is that it is not a builder. It is owning certain immovable property. Now it wants to sell this. So in that case, an advance is received and against which he has to make a payment within, say, next few months or a year. So it may not be its stock in trade. It could be its PPE or investment property too. Na?
Yeah, that way also we may treat it, sir.
So accordingly, as per the contract entered, what is the term within which he has to make the payment and against which the immovable property is to be handed over to him. So there is no concept of advance taken for capital goods. He might be thinking from Abdulji. This question is from Abdulji. He must be thinking about from the compliance from the Companies Act Section 73, where advance is taken again, not again goods, but again capital goods. So more than 365 days is allowed. So from that point of view, maybe.
Yes.
This question from Sushil Lalji, we have taken that as per Ind AS 8, we have to restate the balance sheet on earlier previous year. We have taken this question?
Not yet, sir.
We have
So
taken it, but I think it's just an offshoot of the previous question.
Yeah. Offshoot, because Sushil Lalji is a dear friend. He is also a part of special committee of the ASP also. He has asked two questions, offshoot of the earlier question. He said that date on which we have to pass the entry for the same, and second, as per Ind AS 8, we have to restate the balance sheet on the earlier previous year, that is 31st March 22. Now we have to bring the effect in the current year, that is 31st March 23. Therefore, in which date we have to pass the general voucher?
General voucher.
So this is basically, I think if I remember the question, it is in relation to bonus pertaining to 2021, where they forgot to make a provision for bonus in 2021 and accounted as an expenses and paid in the year 2022. So that is where the originality of the question lies with. So I feel basically what happens is the requirement of the standard is when you are preparing the current financial statement, this is a prior period error. And that error is basically in relation to the getting corrected in the last financial year. So that is where we have to restate the comparative last year financial statements. Okay. So we will be doing it more as a presentation of financial statements without going back and making the necessary changes in books of accounts. So this will be more of a presentation disclosure requirement than of making the required entries in the books of accounts.
So I think
Right,
there is
right,
no more
right,
question.
because the payment must have been made. So it is not about general voucher. It's not about general voucher. Thank you. Jatinderji, you close, then we'll close.
Perfect. Thank you, Prasad sir. Thank you, Bhavesh sir. This was an excellent session. You answered all the queries in a very, in appropriate manner, wherever required, with the practical examples, sharing your screens on that. Thank you very much, sir, and thank you, Pramod sir. Thank you, Chajar sir, for giving this opportunity to me, sir. Over to you, sir.
Thank you, Jatinderji. In fact, the topics were deliberated in a very interactive way, sharing that your whiteboard, making the whiteboard, and then giving the examples, and that was really good. And you covered most of the questions. The participants are very appreciative of that. And again, thanks for the wonderful job, and to the whole team, and now to Shalini ji and Kulshekar ji from the ASB, and of course to both panelists and the moderator, and now the final word of our Vice Chairman Abhay Chajer.
Thank you. Thank you.
Sorry, I missed those adjectives.
No, that's. Thank you so much for those compliments, which I think it's not
obvious. Obvious. I understand.
No. No. Thank you so much, and of course, on behalf of the Accounting Standard Board, it's truly, I would say, an excellent session, most practical in terms of the explanation and the clarity. I'm sure the participant would have got with Kaleshwar Prasad ji and Bhavesh ji. You explained so well. I believe the effect on the financial statement and the disclosures requirement, the changes, the estimates, all those I think has been very well covered. And I believe such type of sessions, me and Pramodji always try, because someone like you coming, speakers, practically explaining on a whiteboard and making members understand. I think this is what the real objective of webinar, when you don't have physical programs sometimes, but even then it looks more as a physical program when you are explaining. So thank you so much for being here. And of course, if there's any question which we receive participants later, we'll certainly get back to you and get a response for the participants, so that more clarity is obtained and passed on to the participants. So, and again, Jatinder ji, thank you so much for being here. and making yourself available for almost 2 hours. And of course, your preparation, I'm sure you must have done before this also. So thank you so much for being here and moderating this important session. Thanks to Shalini and Kulshekhar, and of course the IT team of ICI, and my chairman Pramod Jainji, for always ensuring that I am the last one whenever the webinar is there, that I end up the webinar, and that's because I have this the opportunity of working with him and under him. Thank you one and all the participants for being here, and I'm sure every participant would have been benefited and enriched with this vast knowledge and experience these experts possess. Thank you one and all. Thank you.
Thanks to all.
Thanks to Pramod and thanks to Abhayji. Thanks for this opportunity.
Thank you.
Thanks.
Thank you. Thank you very much. Thanks for joining.
Thank you.